Today, one key inflation metric posts its biggest annual gain in history as Wall Street continues to fret over rising prices. Plus, with rising wages and ample openings, 2021 could be the year of the summer job if you're a teenager. And finally, Elon Musk promises you can buy a Tesla with Bitcoin again, eventually. I'm MacKenzie Sigalos, and this is CNBC After Hours. Stocks finished the day lower, with the S&P and Nasdaq falling from record highs as investors wait and see how the Fed will address fears over rising inflation. We got our latest sign today that prices for everything are climbing more quickly than expected. The Producer Price Index, which measures production costs for businesses, jumped 6.6% over the last year. That is the largest jump ever since officials began tracking this data in 2010. Another sign of sky-high prices, the red-hot housing market. We got another look at homebuilder sentiment today, and it fell to its lowest level since August of 2020. One reason for the drop in confidence is the cost of lumber. Although prices have fallen 10% from its peak, lumber prices remain high while supply remains low. CNBC's Olick tells us more.
The price of lumber shot up dramatically during the pandemic because of all kinds of supply chain issues on top of really high demand from home builders and remodelers. It has come down slightly in the last month or so, but it's still about 275% higher than it was pre-pandemic. And that means much higher costs for the builders, which then they're, of course, passing on to home buyers. Lumber prices are so high right now that some builders are actually delaying putting up the houses because they don't want to build at such a high price. Some builders are also doing what's called escalation clauses, which we normally see in the existing home market. That is, that a person who wants to buy a home will say, oh, I'll offer this price and I would escalate up to this price. Well, in the new home market, builders are now saying, we'll sell you this home for this price, but it could actually cost X amount more if our prices for lumber and other commodities rise by then. And believe it or not, buyers are agreeing to that because they want the homes that badly. One interesting thing that's coming up with the builders now is that they're saying that the appraisals for their construction loans are not meeting the actual prices of houses. So what that means is for smaller builders who actually make up 2/3 of the housing market, they have to get a loan to build a house. And just like when you're buying a house, they go to the lender, they say, we're going to put up this house and we expect to sell it for this price. Well, prices are rising so quickly that those appraisals are not matching up, which means the builder is either going to have to put in more equity of their own, or they're not going to be able to build the house because they won't be able to get that loan. For buyers, what this means is that prices of newly built homes are just rising faster than ever before. We're seeing 20% increases year over year in the median home price for new construction. That means some buyers are simply being priced out. Yes, we do have near record low mortgage rates, but they're just not making up for that huge price gain. So what we're seeing now is huge demand for single family rental homes, and now those rents are rising much more quickly as well. So if you're trying to get a home, whether it's buying or renting, it's just going to be that much more expensive. This is definitely a part of that larger economic inflation story. Housing is really the leading inflator of all of this. We're seeing home prices rise, we're seeing rents rise, and what's happening then is that people get priced out, and that should eventually slow the market, but we're in a very unique market now in that there is so much demand pushed by demographics and so little supply that there's really not a lot that prices can cool off that much. What some are arguing is that the government has to get out of the mortgage business. That is, they need to stop buying mortgage-backed bonds and keeping mortgage rates so low, because if mortgage rates were to rise a bit, that would probably take the heat out of some of these home prices.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
In Jack's case, he's fine. He's lying low right now. I talk to him every day. I actually message him. We have our own, messaging platform. He's actually doing very, very well. He's taken up painting as a hobby. It's actually pretty good.
There is no blueprint that exists for how to build a company like this. And that's the whole point of how, seemingly wouldn't even make sense for like a Thiel fellow or someone particularly, early on in the career to be able to build something like this over this period. Now, it's an illusion that it happened overnight. This was a 10-year process in terms of what we had to do. It just got an early head start for all of this. So, we've been able to accelerate through and make it happen.
The return on investment for JP Morgan is one of the best in the industry, and we think they're in a really unique position to be able to ultimately compete, partner, and even acquire some of these fintech companies. Why? Because they have a retail footprint in the United States that services about 60,000 customers, and they have all this massive amount of data.
Everybody talks about infrastructure. We always have. You remember President Trump talked about a $2 trillion infrastructure plan, and others have talked about it, including President Biden during his campaign. So let's get this done. I mean, this is about roads and bridges that are crumbling. This is a need out there, and people want an infrastructure bill because they know that this will help our long-term economic growth. So I think it's a good idea.
All right, so it's no secret that businesses have struggled to find workers as the United States gets back to business. McDonald's, Chipotle, Costco, and Bank of America all have announced wage hikes to attract talent. In fact, last quarter, wages grew at their fastest pace since the 1990s, and teenagers are rushing into the job market at record pace in order to take advantage. CNBC.com's Natalie Zhang explains.
2021 is the year of the summer job. After years of declines, the employment rate for teenagers is at its highest level since 2008. The unemployment rate for workers aged from 16 to 19 fell to its lowest since 1953.
Employers are suddenly scrambling to hire workers as we are reopening more parts of the economy. And these are often entry-level, low-wage jobs in things like restaurants and hotels and retail stores. So exactly the segment where youth would be able to fill those kinds of jobs. And they're often very willing to be able to go out and take those jobs right now, especially since employers are even increasing the rate of pay.
That's left owners like Lyman Chen struggling to find workers. He's run Haagen-Dazs ice cream franchises since 1989. He says high school and college students usually make up 65% of his workforce. But this season is looking different.
Prior to pandemic, we should be easily get approximately 15 to 20 employee part-time of those high school student or college student. And this year so far, we got only one. And so that is very unusual. The source is just not there.
To make sure he has enough employees heading into the busy summer season, Shen has started giving more bonuses, something he only gives out once a year.
We also raised the wages by 15 to 25% to our existing employee, regardless they are full-time or part-time. We planning to give another bonuses to people that has been working for me more than 2 years.
High school senior Rachel Mendoza started looking for work back in February. She applied to fast food chains Dunkin', Panera Bread, and dance schools. She says a lot of it has come down to connections.
Do you know this person and do they like you? And it's kind of getting competitive where some people have the upper hand and some people know about it later, and it's just who gets there first, who knows about it.
Mendoza is hoping to earn pocket money, but also to give back to her parents.
I'm really excited to finally be able to put on some uniform if I hate it or if I don't, but like just being able to contribute.
Not every teenager might be able to find a summer job so easily.
It's always been the case that youth of color, particularly inner city, low-income youth, have difficulty finding job opportunities. On the other hand, lots of white youth live in places that have more job opportunities. Their parents are connecting them to different job opportunities. And so we have this uneven playing field that's been in existence for years, but still plays out even in a strong labor market.
Economists say the surge in teen hires doesn't look like it'll stick after the pandemic.
I don't see it having really strong, long-lasting effects into next year. I think that we'll see some improvement in terms of employers being more willing to hire youth and youth having some additional experience they gained this summer. But I think this is a one-time opportunity here.
Okay, before we go, let's get to our numbers round. We'll start with 50. It is only a matter of time before Tesla accepts Bitcoin as a form of payment again, at least according to Elon Musk. The Tesla CEO took to Twitter on Sunday to promise that the car maker will let customers pay for one of its vehicles with the cryptocurrency once he's seen proof of at least 50% clean energy usage by miners. Now, it's still unclear just how Tesla will measure clean energy usage, but Bitcoin traded higher on the news. It surged back over $40,000 for the first time in over a month. And finally, $11.2 trillion. Corporate debt ballooned to $11.2 trillion in the COVID-19 pandemic as companies took advantage of low interest rates. Now, according to FactSet, cruise lines and airlines were among the biggest borrowers as they struggled to withstand the worst of the pandemic-led recession. Now, what's driving the record levels of corporate debt? Well, that is rock-bottom interest rates. They have been a major culprit, and tomorrow, investors will get an update from the U.S. Federal Reserve on where they see rates heading as inflation heats up. Stay up to date on our coverage of tomorrow's Federal Reserve rate decision by going to CNBC.com and downloading the CNBC app. Now that's it for After Hours. We will be back here every Tuesday and Thursday, so be sure to catch us then.